Hello and welcome to Weekly Outlook number 7. Last week, it seemed like everything was selling off, and if you look at the stock market for the last 20 days, it has been a falling knife. Now, everywhere you look at, there has been fear instilled into the market saying the market is crashing, you see all the red, you see everything coming down, but I think that we are in a position now this week where the stock market could pivot from the bottom. I'm not saying that I'm calling the bottom and that it can't go lower from here, but I do see some characteristics that could go ahead and temporarily stop the fall. And perhaps if there's enough buyers met, we can go ahead and go further from here and continue our bullish momentum for the stock market. Now, there's also a lot of opportunity in the currency market where I thrive at that I'd like to share and leave everybody with some actionable steps that they could potentially profit off of. Looking at my top setups here, and what this does, it just consolidates all of the relevant data that moves a market, currencies, equity indices, commodities. It gathers all of the data points that move markets, and it visualizes them and puts them in a very easy to read visualization. We see at the very top we have the euro being very strong. You have euro Australian dollar, which is very interesting, and I'd like to go into it further. I think that is a very opportunistic trade. Euro New Zealand, pound, euro dollar, all being bullish. Dollar Swiss, dollar yen being bearish. Now we see that the equity indices are not bullish or bearish. That tells me that there could be a chance that the fall has stopped and that we could go ahead and see some rebound. Now I want to dive into the commitment of traders data, and what this is institutional players, banks, hedge funds, endowments, anyone that speculates on the market that has a big positioning has to report their positions to the CFTC, and you can gather the positive and the negative, gather a net position, and kind of see where markets are leaning towards. Now the cool thing is we can see this change happening week over week, and if we see here the S&P 500 got bought. It was the most bought asset out of all of them, had a 3.82% net increase, and you see that short contracts, 35,900 short contracts were removed and 14,584 long contracts were added. What that tells us is that short contracts, people that were shorting the market, they went ahead and took those positions out of the market. That could have meant that they were taking profits or they just removed themselves, but that is a really good indication that the bearish pressure has been lifted and relieved. You saw that 14,584 long contracts were added to the S&P 500, and now we have a net position of 85,312 long contracts for the positive. Now, another thing that's really interesting, US dollar, euro, and pound, they all got bought pretty much evenly, with the dollar and the euro both around the 3% range. And if you see that their net position is pretty much the same, give or take 3,000 long contract. That is very interesting. You saw that the Australia, New Zealand got sold, the Canadian dollar got sold, the Nikkei, which is the Japanese stock market, they went ahead and sold that heavily. 7% net change in the negative here. It is at a whopping minus 122 short contracts, which is not bad. But usually what you see, and it's not always the case, and it's not a perfect situation, but what usually happens is you see the currency appreciate and the equity indices for that country or economy depreciates. Now it's not perfect. They don't happen all the time like that. If it was, everyone would just be profiting from the market. There are times when the equity indice and the currency for that economy can appreciate and depreciate at the same time. But that is a good thing that I like to see when I'm going for the long yen play. Now, one thing I really want to highlight is the retail sentiment. And usually retail traders or investors like you and I and everyone else that doesn't work at a big banker institution, we are the retail people. And statistically, the retail trader or investor is usually wrong, and their timing is always pretty bad. And one thing that you always see is people go ahead and buy at the wrong time. As soon as they buy, the market sells off, and as soon as they sell, the market tends to rally. One thing that has been shoved down our throats for the past 20 days is that the market is selling off and that a recession is near. Now, the data doesn't really say that. I don't think that economic data like growth and inflation has been so bad to indicate that we are potentially going into a recession. Are we on the fence? Probably. But are we in recession territory? No, we're not. And that is what has been, being advertised to everyone. And I saw I was watching a live stream, and someone said that their grandmother said to sell the stock market. And so when you see and hear things like that being said, that is a good indication that the fear is at the peak of its level. And that's when institutional players, buyers in the market, tend to step right in when prices are heavily discounted. And if you see here at the retail sentiment, you see that the S&P 500, 91% of retail traders or investors are shorting that market, and only 8% are long. Now, we reference the COT data that we just saw. We saw that lots of buyers stepped in for the S&P, and that a lot of short players went ahead and took themselves out of the market. So if we look at the chart for the S&P, we see that we kind of saw that. We're seeing some sort of a rebound. What I'd like to see, and a play that I would say is a pretty safer bet, let's say the S&P 500 holds above this level of support here. If we see it hold, break, and retest, then we could see some more upward movement. Now, we could target the all-time highs, or we could just stay in this range that we've been in. If you see, back since September, we've been just hanging out in this range. So we could target, this previous level here, and then if we go ahead and clear that, then we could just hang out in this range, or we can, aim for all-time highs if we continue past that, and then from there, we reevaluate at that point. Now, one indicator that I love to look at when we're measuring these volatile, crazy movements is the VIX, the volatility index. So what the VIX tells us is all it's doing is measuring the anticipated volatility in the options market for the year. The VIX, when it spikes up, there's usually big movements to come. And when it starts to fade and come back down, that shows us that the volatility expectation is stabilizing in the market, and we could start to see some more organic moves that are not that impulsive. Now, looking back here, we saw that the VIX approached the 30 handle, and now we're starting to fade back down. Now, what happened over here on this side? Now, if we just look at history and what happened in August 5th, we saw that the VIX went ahead and peaked, and as it was coming back down, the market started to rebound itself. So this happened in the August 5th sell-off. You see August 5th spiked up and then came back down. So let's go ahead and reference the S&P 500 at that time. So we saw the S&P 500 around that time. This is the August to the August 5th scenario. We went ahead and sold off aggressively as the VIX was bottoming out. We saw some retracements back to where we were previously, and then we went ahead and eventually started making new highs, and now the same situation is happening here. That is an indicator that I like to see that could show that the market is stabilizing a bit. Now, what happened on March 5th was interesting for the euro. The euro saw a 500 pip appreciation in a matter of like 2 days, and that was off the backs of Europe committing 800 to 500 billion dollars or euros for their military spending. And what they want to do is become more military independent. That could, go ahead and, now what that means is more participation in the market, perhaps more jobs, and so that is a good thing for the European economy. Now, for the euro, if we zoom out here, we see that we are in this range. We've been in this range for a little bit here. You see this very ugly squiggly line that I did. It's not very straight, but we see that we've been hanging out in this range. And so when the euro went ahead and appreciated really fast, we broke out, and now we're in this awkward situation. We are practically in the middle of the range, and if we're anticipating a strong euro dollar against the US dollar, you have to see where can we buy this market at. So one thing that I would like to wait for is pullbacks. If we can get a pullback back into this zone here and then continue buying, then that would be a safer bet, considering that we're in the middle. But there's a possibility that in the very strong market like this, any brief pullback gets bought into immediately. One thing I'm just gonna have to deal with is be patient for the pullback. If we just continue rallying and rallying and rally, then good chance that I just missed the trade. One thing that we saw on the top set of plays was the euro Australian dollar. This one was a trade that I really liked. It appreciated like about 1,000 pips, and the same time that we saw that super fast appreciation for the euro dollar, we appreciated like 1,000 pips. If we measure it here, 1,056 pips. I would like to wait, just like the euro, for a pullback. I would like to see if we can get into the zone here. That would be probably my first entry. My second entry would probably be somewhere here. Now let's say we blow past this zone. That's when I would use my discretion and not take my first entry here and just wait for my first entry to be somewhere in this zone here. And then I can have my stop loss somewhere below here maybe, and then my reward will be targeting the all-time highs. And if we look left, we actually have quite a bit of gains to reference here. If we look back here, we have all of this upward movement. Now, are we gonna get 2,700 pips worth of appreciation? Probably not in the near term, but you have all of those levels to your left to reference. So that's what I would look for. Ideally, my first entry would be here. My stop loss would be about 200 pips, and my take profit will be about 700 pips. So to me, that's a good risk reward. This will be a good swing trade. Hopefully we can go ahead and get a retracement all the way back down to here. If we just look at a fib, this retracement level is right exactly at the 61.8% retracement. So that will be a really good setup. And if that happens, then most likely than not, the euro dollar will also kind of go ahead and retrace quite a bit. And so we can get those really good, attractive buy entries on those two pairs. Another thing I want to mention is the Swiss yen position that I'm in. It is currently now at break even. I was up eventually. I was up about 300 or so pips, and so now we're just hanging out at the break even level. We do have a Bank of Japan on March 18th. They're going to have a rate decision. It seems like they're going to hold the rates where they are at half a basis point. But what the market wants to see, and what I want to see, is that rate hold a dovish or hawkish stance? That'll be a good indication as to where they are leaning, for the future. It seems like the Bank of Japan actively wants to go ahead and hike the rates, and the data supports it, but they're not in a rush, and they're actually being pretty cautious to not go ahead and hike too fast because of a unstable appreciation. I think they want the yen to appreciate pretty organically, and they want to hike the rates at a safe pace. So that's what I'm looking at, guys. Thank you so much for watching. I hope you guys found some value in this video. Bye-bye.